What if I told you that a psychiatrist discovered the exact formula that separates winning traders from losing traders? What if this same psychiatrist worked with professional traders for over 30 years and found that 90% of trading failures come down to just three missing elements? What if mastering these three elements could be the difference between blowing up your account and building generational wealth? The man I am talking about is Dr. Alexander Elder. And his discovery is so powerful that it has become the foundation for every serious trading education program in the world. Stay with me because I'm about to break down the exact 3M formula that has created more successful traders than any other system in history. And by the end of this video, you will know exactly which of these three areas is sabotaging your trading and how to fix it starting tomorrow. But first, if you want to master trading psychology like the professionals, hit that subscribe button right now because we are revealing the secrets that Wall Street legends have used for decades. Before we dive into the formula, you need to understand who Alexander Elder is and why his approach is so revolutionary. Dr. Alexander Elder is not your typical trading guru. He is a medical doctor. He is a trained psychiatrist, and he spent decades studying the human mind before he ever touched a trading account. But here is where it gets interesting. When Dr. Elder started trading, he brought his psychiatric training with him. He started analyzing why traders fail not just from a market perspective, but from a psychological perspective. What he discovered changed everything. Most traders fail not because they do not understand markets. They fail because they do not understand themselves. Dr. Elder realized that successful trading is not about finding the perfect strategy or the secret indicator. It is about mastering three fundamental elements that work together like a three-legged stool. Remove any one of these elements and the entire system collapses. He called these elements the three M's: mind, method, and money. And here's the part that will blow your mind. After working with thousands of traders over 3 decades, Dr. Elder found that 95% of failing traders are missing at least one of these three M's. But the traders who master all three, they become consistently profitable. Let me ask you a question. When you first started learning about trading, what did you focus on? If you are like most people, you focused on finding the perfect strategy, the magic indicator, the secret pattern that would make you rich. You spent months or maybe years studying charts, learning technical analysis, backtesting systems, optimizing parameters. But here's what probably happened. You found a strategy that worked great in backtesting. You were excited, you started trading it with real money, and then something strange happened. The strategy stopped working. Or you started making mistakes you never made in backtesting. Or you found yourself unable to follow your own rules. You probably thought there was something wrong with the strategy, so you went looking for a better one, and the cycle repeated and repeated and repeated. Dr. Elder calls this the method trap, and it is where 90% of traders get stuck. They think trading success is all about method, finding the right strategy, the perfect system, but Dr. Elder discovered something that changes everything. Method is only 1/3 of the equation. You can have the best trading strategy in the world, but if your mind is not prepared and your money management is flawed, you will fail every single time. This is where Dr. Elder's psychiatric background became his secret weapon. He realized that successful trading requires three elements working in perfect harmony. The first M is mind. This is your psychology, your emotional control, your mental discipline. It's your ability to stick to your plan when the market is trying to shake you out. The second M is method. This is your trading strategy, your entry and exit rules, your market analysis. It is your systemic approach to finding and executing trades. The third M is money. This is your risk management, your position size, your capital preservation. It's your ability to survive inevitable losing streaks. Now here is the critical part that most people miss. These three M's are not independent. They're interconnected. They depend on each other. Weakness in one area will sabotage the other. Let me give you some examples of what this looks like in real trading. You have a great method and solid money management, but your mind is not disciplined. Result? You will override your system when you are emotional and turn winning strategies into losing ones. You have great mental discipline and solid money management, but your method is flawed. Result? You will perfectly execute a losing strategy and lose money consistently. You have great mental discipline and a solid method, but your money management is poor. Result? You will be right about the market, but size your trades incorrectly and blow up your account anyways. All three M's must work together. There are no exceptions. Let me start with the first M, which Dr. Elder considers the most important: your mind. Dr. Elder found that most trading failures come down to two emotions: fear and greed. Fear makes you exit winning trades too early. Fear makes you avoid taking trades when your system gives you a signal. Fear makes you freeze when you should act. Greed makes you hold losing trades too long, hoping they will come back. Greed makes you risk too much on single trades. Greed makes you overtrade when you should be patient. But here's what makes Dr. Elder's approach different from other trading psychology methods. He does not tell you to eliminate emotions. As a psychiatrist, he knows that it is impossible. Instead, he teaches you to master your emotions through three specific techniques. Technique number 1. Create a written trading plan before the market opens. Not a mental plan, a written plan. When you write something down, you engage a different part of your brain. You make a commitment that is harder to break. Technique number 2. Use pre-trade routines. Just like athletes use routines before they perform, successful traders use routines before they trade. This creates consistency and reduces emotional decision-making. Technique number 3. Practice mindfulness during trading. This means being aware of your emotional state in real time. When you feel fear or greed rising, you acknowledge it, but do not let it override your decisions. Dr. Elder worked with a trader who was making money on paper but losing money in real trading. The problem? Every time the trader had a winning position, fear would kick in and he would exit too early. Using Dr. Elder's mind techniques, this trader learned to recognize when fear was influencing his decisions. He created a written rule that he could not exit a winning trade for the first hour after entry unless his stop loss was hit. Result? His average winning trade size doubled and his profitability increased by 60%. The key insight here is that mastering your mind is not about becoming emotionless. It is about becoming emotionally intelligent. The second M is method, and this is where Dr. Elder's approach differs dramatically from most trading education. Most people think method is about finding the perfect indicator or the secret pattern or the secret sauce. Dr. Elder teaches something completely different. Your method is not just your entry and exit rules. Your method is your entire systemic approach to the market. This includes how you analyze multiple time frames, how you confirm your signals, how you manage your trades once you are in them, and how you adapt to changing market conditions. Dr. Elder is famous for teaching multi-time frame analysis. This means you never take a trade based on just one time frame. If you are day trading, you look at the daily chart for trend direction, the hourly chart for setup confirmation, and the 5-minute chart for precise entry timing. Why does this work? Because it forces you to align your trades with multiple layers of market structure. You are not just guessing, you are trading with the weight of evidence from multiple perspectives. Let me give you a practical example. A trader sees a bullish pattern on the 5-minute chart and wants to buy. But when he checks the daily chart, he sees that price is approaching major resistance. When he checks the hourly chart, he sees that momentum is actually weakening. Without multi-time frame analysis, he might take this trade and get stopped out. With multi-time frame analysis, he either skips the trade or waits for better confirmation. Dr. Elder worked with a swing trader who was struggling with inconsistent results. The trader had a decent entry system but was getting whipsawed frequently. When they realized the trader's journal, they discovered the problem. The trader was taking signals from the daily chart without checking the weekly trend or the 4-hour momentum. By implementing multi-time frame analysis, the trader's win rate improved from 50% to 72%. But here's the most important part about method. Dr. Elder teaches that your method must match your personality and your lifestyle. If you are impatient, day trading might appeal to you, but swing trading might be more profitable. If you have a full-time job, you cannot use methods that require constant market monitoring. Your methods must be something you can execute consistently given your personal constraints and psychological makeup. The third M is money. This is where Dr. Elder revolutionized risk management with 2 simple rules that have saved countless traders from ruin. The 2% rule and the 6% rule. The 2% rule states that you never risk more than 2% of your trading capital on any single trade, ever, no exceptions. If you have $10,000 account, you never risk more than $200 on a trade. If you have a $100,000 account, you never risk more than $2,000 on any trade. This rule is not optional. It is not a guideline. It is the foundation of professional money management. But Dr. Elder did not stop there. He created the 6% rule to protect traders from devastating monthly losses. The 6% rule states that if your losses for the current month plus the risk on your open positions reaches 6% of your account, you stop trading for the rest of the month. Let me explain why these rules are so powerful. The 2% rule ensures that no single trade can seriously damage your account. You would need to have 50 consecutive losing trades to lose your entire account. The probability of that happening with any decent trading method is essentially 0. The 6% rule prevents you from revenge trading or digging yourself into a deep hole during bad months. It forces you to step back, analyze what went wrong, and come back fresh the next month. I know what you are thinking. 2% does not sound like much. How can you make serious money risking only 2% per trade? Here's the math that will change your perspective. If you risk 2% per trade and make 3% per winning trade, you only need a 60% win rate to make 24% per year. That is phenomenal performance that beats most professional money managers. But if you risk 10% per trade and make 15% per winning trade, you need a 75% win rate just to break even, and one bad streak will wipe you out. Dr. Elder worked with a trader who was making huge returns for months, but kept blowing up his account. The trader would make 300% in 6 months, then lose it all in 2 weeks. The problem? The trader was risking 15 to 20% per trade during hot streaks. When they implemented the 2% rule, something interesting happened. The trader's monthly returns dropped, but his yearly returns actually increased because he stopped having accounts destroying drawdowns. After 2 years of following the money management rules religiously, this trader achieved consistent profitability for the first time in his career. Now let me show you how the 3 M's work together in real trading situations. Scenario 1. Your method gives you a buy signal. Your mind is calm and focused. Your money management tells you to risk 2%. You take the trade with confidence and stick to your plan. Scenario 2. Your method gives you a buy signal, but your mind is stressed because you just had 3 losing trades in a row. Your money management says you are approaching the 6% monthly limit. The right decision? Skip the trade or reduce your risk even further. Scenario 3. Your method gives you a buy signal. Your mind is calm, but your money management shows that this trade would risk more than 2% to reach your logical stop loss. The right decision? Skip the trade or find a better entry point. This is integration. This is how professional traders think. They do not just look at charts and place trades. They consider all 3 M's before every decision. Let me give you a real-world example of what this looks like. A trader I worked with had a simple breakout system. When price broke above resistance with volume, he would buy. Before learning the 3 M's, he would see the breakout, get excited, and buy immediately with whatever position size he felt. After learning the 3 M's, his process became systematic. First, he would check his mind. Am I calm and focused? Or am I emotional from previous trades? Second, he would check his method. Is this breakout confirmed on multiple timeframes? Does volume support the move? Third, he would check his money management. What position size gives me exactly 2% risk based on my stop loss? Am I within my monthly risk limits? Only after all three M's aligned would he take the trade. The result? His win rate stayed about the same, but his average loss decreased dramatically and his consistency improved enormously. Over 12 months, this systemic approach turned a break-even trader into a consistently profitable one. There's one more element of Dr. Elder's system that separates it from everything else: the commitment to continuous education and systematic improvement. Dr. Elder teaches that trading is a skill like surgery or playing piano. You never stop learning. You never stop improving. This happens through two mechanisms. First, keeping a detailed trading journal, not just recording your trades, but analyzing your decisions. What was your emotional state? Did you follow your method precisely? Did you stick to your money management rules? Second, continuously study, reading new books, attending seminars, analyzing market changes, adapting your approach as markets evolve. The traders who embrace continuous education have a massive advantage over those who think they can learn a system once and use it forever. Markets do change. New participants enter. Technology evolves, and your approach must evolve too. But here's the key insight. You do not have to abandon the 3 M's when markets change. You refine and improve them. Your mind techniques might need updating as you gain experience. Your method might need adjustments for new market conditions. And your money management might need fine-tuning based on your track record. But the framework remains constant. Mind, method, money. Let me give you a practical implementation plan you can start using tomorrow morning. Step 1. Assess which of the 3 M's is your weakest area. Be honest with yourself. Most traders know intuitively where their biggest weakness lies. Step 2. If your mind is the problem, start with a written trading plan and pre-trade routines. Write down exactly what you will do in every market scenario before the market opens. Step 3. If your method is the problem, implement multi-timeframe analysis. Never take a trade based on just one timeframe. Always confirm with at least 2 additional timeframes. Step 4. If your money management is the problem, implement the 2% and 6% rules starting immediately. No exceptions, no excuse. Step 5. Start keeping a detailed trading journal that covers all 3 M's. Record your emotional state, your method execution, and your risk management for every trade. Step 6. Review your journal weekly. Look for patterns. Where are you making mistakes? Which of the 3 M's need more work? Do not try to fix everything at once. Pick one area and work on it consistently for 30 days. Then move to the next area. Remember, professional traders spend years mastering these skills. Give yourself time and be patient with the process. Let me share some advanced applications that show the real power of this system. Case study 1. A futures trader was struggling with overnight risk. His method worked well during regular hours, but overnight gaps were killing his performance. Using the 3 M's framework, he made 3 adjustments. Mind. He created specific rules for when to hold overnight versus when to close before the session end. Method. He added overnight sentiment analysis to his system. Money. He reduced his position sizes by 50% for any trade he held overnight. Result? His overnight win rate improved and his overall performance increased by 30%. Case study 2. An options trader was making money during trending markets but losing during sideways markets. Using the 3 M's framework, she made these adjustments. Mind. She learned to recognize when markets were transitioning from trending to sideways and adjusted her expectations. Method. She developed separate strategies for trending and sideways markets. Money. She reduced her overall risk during uncertain market periods. Result? She turned break-even performance during sideways markets into modest profits. Case Study 3. A swing trader was struggling with position sizing. He would risk too little on high-probability trades and too much on marginal setups. Using 3M's framework, he created a confidence scale from 1 to 10 for each trade setup. High confidence trade got the full 2% risk. Medium confidence got 1%. And low confidence got 0.5% or were skipped entirely. The result? His risk-adjusted returns improved by 45% because he was allocating capital more efficiently. These case studies show that the 3M's framework is not rigid. It is flexible and can be adapted to any trading style or market condition. Let me address the most common mistakes traders make when implementing the 3M system. 1. Focusing on only one M at a time. Some traders work on their psychology but ignore money management. Others perfect their method but never develop mental discipline. You must work on all 3 M's simultaneously. 2. Thinking the 2% rule will limit your profits. The opposite is true. The 2% rule maximizes your long-term profits by ensuring you survive inevitable losing streaks. 3. Making the system too complicated. The beauty of the 3M's is its simplicity. Do not overthink it. Mind, method, money. That is it. 4. Giving up too quickly. Building trading discipline takes time. Most traders need at least 6 months to see significant improvement. Stick with the process. 5. Not keeping a journal. Without systematic record keeping, you cannot identify patterns or measure improvement. The journal is not optional. Let me explain from a psychological perspective why the 3M system is so effective. The human brain has 2 decision-making systems: the emotional system that reacts quickly and the logical system that thinks systematically. Most traders rely too heavily on the emotional system. They see a setup, feel excited, and trade impulsively. The 3M system forces you to engage your logical system before every trade. You must check your mind, verify your method, and confirm your money management. This creates what psychologists call a cognitive firewall, a systematic pause between impulse and action that dramatically improves your decision quality. Dr. Elder understood this from his psychiatric training. He knew that successful trading is not about eliminating emotions, but about creating systematic processes that prevent emotions from driving decisions. The 3M's framework is essentially a decision-making system that harnesses both your emotional intelligence and your logical analysis. The 3M's framework works for every trading style, but the specific implementation varies. For day traders, the mind component might focus on maintaining concentration during fast-moving markets. The method component might emphasize quick pattern recognition, and the money management component might use smaller position sizes due to high-frequency trading. For swing traders, the mind component might focus on patience and avoiding overtrading. The method component might emphasize weekly and daily chart analysis, and money component might allow slightly larger position sizes due to lower frequency trading. And for position traders, the mind component might focus on staying committed to long-term themes despite short-term volatility. The method component might emphasize fundamental analysis combined with technical timing. And the money component might use the smallest position sizes due to longer holding periods and higher volatility. The framework remains constant. The specific techniques adapt to your style. Dr. Elder teaches that successful trading is not gambling. It is a business. And like any business, it requires systematic processes and continuous improvement. The 3M's framework provide the foundation for treating trading as a professional business. Your mind becomes your CEO, making strategic decisions based on clear thinking rather than emotional reactions. Your method becomes your product, providing consistent value through systematic market analysis and execution. Your money management becomes your CFO, protecting capital and ensuring long-term sustainability. When you integrate all three M's, you transform from someone who gambles in the markets to someone who runs a professional trading business. This mindset shift is crucial for long-term success. Dr. Alexander Elder did not just create a trading system. He created a complete framework for trading success that addresses the three fundamental requirements of any profitable trader: mind, method, money. Master all three and you join the small percentage of traders who achieve consistent profitability. Neglect any one of them and you join the majority who struggle and eventually quit. The choice is yours. But here's what I want you to understand. This is not theory. This is not speculation. This is a proven system that has worked for thousands of traders over more than 30 years. The principles have not changed because human psychology has not changed. Fear and greed still drive most trading decisions. Lack of systematic thinking still causes most failures. And poor risk management still destroys most accounts. But now you know the solution. If this video has changed how you think about trading success, hit that like button right now. It helps other serious traders discover this information. Leave a comment and tell me which of the three M's is your biggest weakness: mind, method, or money. I will respond with specific advice for your situation. Subscribe to this channel because next week we are covering another legendary trading psychologist whose approach will complement everything you have learned today. And here's your homework assignment. Pick your weakest M and spend the next 7 days focusing exclusively on improving that area. If it is mind, create a written trading plan and start using pre-trade routines. If it is method, implement multi-time frame analysis on your next 10 trades. If it is money, calculate your exact 2% risk amount and use it religiously. Do not wait, and don't procrastinate. Start tomorrow morning. Your future profitable self is counting on the decisions you make right now in this moment. Remember what Dr. Elder discovered through decades of working with both failed and successful traders. Trading success is not about finding the holy grail strategy or the perfect indicator. Trading success is about mastering yourself, mastering your method, and mastering your money. The three M's: mind, method, money. Now you know the formula that separates winners from losers. The only question remaining is, what will you do with this knowledge? I will see you in the next video where we continue building your complete trading psychology mastery. Until then, remember, professional traders are not born, they are made. And they are made by mastering the three M's. Now go build your trading business the right way. Goodbye.